Good afternoon to you all, and today indeed we have a very exciting day. We will start with Professor Doron Avramov, who is the finance professor here at IDC, the Arison School of Business. But I think even more importantly, he's a good friend and one of the greatest experts that I know with a really thorough understanding of financial markets. So I urge you to listen carefully. Because Doron, for me, is one of the guys that really has a very good insight of what's going on. Doron, the floor is yours.
Okay, thank you so much, Niron. And let me actually share our presentation file, okay? I'll just take it to be a full screen. Just let me know that you see the file and everything. Is it there?
It's there.
So, okay, so I'm going to follow this PowerPoint presentation. And, you know, I'm going to discuss investing during crisis in general and the case of coronavirus in particular. And I'm saying in general because what we have seen over the past couple of months is like history repeats itself in many, many ways when it comes to financial markets, okay? So, you know, first and foremost, we define this state in the economy as a black swan. Well, believe it or not, that's the way that such episodes are defined in the profession, in the economic profession, in the finance profession. Black swan, it means that we have a mega event, very unexpected event, and furthermore, the event will have major economic consequences that we won't know until the event is over. And as it actually looks right now, unfortunately, it will take a couple of more months for the event to clear out. The event is still here, and the consequences are here to stay. And perhaps to draw some line along the time series, so we start with January 23rd. You know, around that date, the public got some message from China that there is a virus going on, and furthermore, this virus is unheard of up to that point, and there is not any vaccine. And you know, so things in China don't look good on January 23rd. And then February 20, the virus has spread. You know, first we heard from Italy, we heard from South Korea, Iran, and even Spain. And March 12, the US government has decided to severely restrict travels to US and from US from all over the world, including the European Union. And March 13, there is a declaration of national state of emergency. And then the US government took a strategic decision to massively intervene in the financial markets. You know, the scale of intervention is something unheard of. So this is actually the chain of events, and the event still goes on. I guess there are going to be many more points to define in the future, but now let us see what financial markets, how they have responded. And I'm actually going to have a comprehensive coverage of financial markets, starting with equities. I think that the stock market is the most celebrity within the large comprehensive financial markets that also include corporate bonds, government bonds, commodities like oil, like gold, of course, crypto currencies. So let us start with the stock market. And when we look at either US on the left or Europe, so in the US we have the S&P 500, a major index, reflection of the US economy consisting of 500 major stocks. As you can see, there is a big January effect, namely stocks are going up in January. And then there is this message from China saying, hey, there is some unfamiliar virus going around. At the very beginning, the market responded. There is uncertainty. There is a big there is a big black swan here. But very quickly, the US markets and the European markets, as you can see on the right, have bounced back. And you know, there is definitely a puzzle here. How come that there is a major event in China? Even if the event stays in China and doesn't spill over, still today China is producing more than 20% of the world production. Furthermore, China is a great place for US companies to sell their products. Apple is a good example. So given that there is a major crisis in China, there is slight response in the US, but the response is quickly vanishing. And you know, the index keeps on rising. And here we ask, hey, what happened? How come that US investors have dismissed the threat coming up from China? And at this point, I did read a couple of reports coming up from major banks in the US, like Goldman Sachs, JP Morgan, telling you, hey, no worries, things are fine, things are under control. And the information was there, but I guess the interpretation of information was flawed. And indeed, when the quarantine in Italy starts, and moving from February 26th all the way to March 23 of March was the bottom of the financial markets. Over 4 weeks, major indexes in the US, in Europe, and in Israel went down by more than 40%. So the market is going down. And when the S&P is losing 40%, you know, people ask, what is ahead of us? What should we expect? And you know, many experts in the US said, hey, the markets will keep on dropping, because before the crisis, the markets were too high to be justified by fundamental values. Just to give you some indication, you know, Microsoft, Google, Amazon, and Apple, all of which had market capitalization exceeding $1 trillion US, you know, before the crisis started. So there is some perception that the US markets are overpriced, and now there is the coronavirus coming up, so prices go back to fundamental values. But given the huge uncertainty, you know, people actually predicted that the drop will last. Namely, the S&P is going to drop around 50%, possibly even more. But then, so it happened that in March 23, which is really a very important day, the market reached the bottom. And you cannot really know that this is the bottom of the market, because you don't really know what will happen after that. So only when, you know, 4 weeks have passed, you know, that point has been defined by major US players to be the market bottom. And the prices have actually evolved upward ever since. And a good understanding of what happened in US financial markets, and when we say US financial markets, which pretty much mean all over the world, because the US is really a leading economy. If Wall Street is bad, the world is bad. If Wall Street recovers, the world is recovering. So we really depend upon US financial markets in many, many ways. So one good reflection of what happened in the US is something called the VIX. VIX is the volatility index. Those of you who did study finance in the past, those of you who will study finance in the future, VIX is important, because VIX is a measure of how fearful the markets are. Typically, you know, we see VIX around 11, 12, 13, 14%, meaning the expected market volatility is typically below 20%. If VIX is 20%, we say, hey, it's a high volatility regime. But during the crisis, actually the VIX has skyrocketed. You know, the peak was 84%. What I'm showing to you here is end of day VIX, but the VIX is something that could get quoted on a second by second. So when you see the 84%, I can tell you that day. We don't show it because it was not the closing value of the VIX, but that day the VIX exceeded 100%. That's enormous. And that reflects the uncertainty about the economy. 84% volatility is by no means a huge amount of uncertainty. But then, you know, the VIX dropped. Today, the VIX is around 45%. It's still really high. And looking forward, it's difficult to predict. And I will make a couple of statements looking forward. Now, some actually industries in the US, you know, they really got some fatal crash. Like if you look at the airline industry, so we have many airline companies in the US, American Airline, Delta Airline, Southwest, Alaskan Airline, and so on and so forth. As you can see, AAL is the ticker symbol of American Airline. It's on the top left. American Airline dropped, amazingly so. And, you know, even when the market did recover, American Airline didn't recover. And one legendary investor in the US, Warren Buffett, I tell my students over the past years not to follow his advices because Buffett belongs to the old economy, the economy that came up before the technological sector erupted. So actually Warren Buffett got into this crisis with huge amount of stocks into US airlines. As a result, a week ago, Berkshire Hathaway reported a loss of about 50 billion US dollars. That's an enormous loss. The hotel industry, Hyatt, Hilton, they all actually dropped. The cruise, like Carnival Cruise, Carnival Corporation, Royal Caribbean, they dropped. And if you look at the leisure industry, which is actually bottom right, so this one is an ETF. ETF is a collection of stocks within this industry. You can see the major drop of those companies, those firms dealing with leisure and entertainment. In Israel, we have the case of El Al, of hotels, of restaurants. Unfortunately, there is definitely a fatal crash. On the other hand, it turns out that the coronavirus has been perceived to be a technology boosting event. You know, of course, if you look at Netflix, so during the crisis, people consume more of Netflix services. And you can see that Netflix did drop during March, getting a bottom at March 23, but ever since it went up dramatically. And the point today is higher than the beginning of the crisis. Apple reported financial statements exactly previous Friday. Earnings did fall. And Apple actually reported profitability for the quarter ending in March. So Apple doesn't still report what happened in the following quarter, like April, May, and later June. But you know, the results were so-so. Nevertheless, Apple is traded today on a record price. In fact, if you look at the technology sector represented on the bottom right by a mutual fund or an ETF called XLK, you can see the big drop, but the big bounce back. Actually today, and this is perhaps a puzzle, the Nasdaq has recovered all the losses following the crisis of the corona. And we have this company, Zoom, that currently we are using the services of Zoom. By the way, don't rush and buy Zoom after this lecture, because the coronavirus has done very well for Zoom. Because previously there were only a few users, and today millions around the world keep on using Zoom. On the other hand, you know, whenever we invest, we ask, you know, of course, people are going to use Zoom in the future, but the price today is forward-looking, so the price should reflect what will happen with Zoom in the future. So whenever we think, you know, hey, right now Zoom is at stock, it doesn't really mean that we need to rush to buy Zoom because the market is already pricing in. In fact, if anything, it might be the case that Zoom is going to lose from the crisis because right now, the huge technology companies, including Microsoft and Facebook, are building basically, right now they are very strong into coming up with alternative setups that will replace Zoom. And Facebook is very strong, Microsoft is very strong. So I wouldn't be surprised if at some point in the future, Zoom can disappear. And, you know, in Israel, the same thing, you know, in Israel, the Tel Aviv Stock Exchange, we see that we follow the US financial markets. So first there is this coronavirus coming up from China, the market is responding. And then again, we look at the US is bouncing back in January. So the Israeli stock market is bouncing back, having some peaks in February and then drops. And just like the US markets have recovered, also the stock exchange in Tel Aviv has recovered. Excluding some niches, like if you look today at the real estate in Tel Aviv or the financial sector, financial is typically banks, insurance companies, and brokerage firms. So the real estate is about 21% down from the beginning of the year. But once you look at other indexes, so the drop is really mild. And, you know, there are actually a couple of things to be said here. I give you some summary, and there are a couple of things, and here I actually copy and paste from the Israeli media that during February and March, when the markets were collapsing, so, you know, retail investors like you, like me, retail means not institutional investors, they actually withdrew about 40 million Israeli shekels from pension funds and from other saving funds. And, you know, this history always repeats itself. Namely, the market drops and people are, you know, pulling out. And then during April, you know, there is an index called Tel Aviv 90. Okay, it actually bounced back by 40%. So all those investors, all those retail investors who pulled their investments, they really lost the recovery. And, you know, whenever we look actually at crisis period, so here I give you a very comprehensive outlook on the S&P. We have lots of records on the S&P 500. And it shows you that nothing we can do. Whenever we invest in equities, oftentimes the market falls. Nothing we can do about it. Just look at the Great Depression from 1929. The market drops by more than 50%. You know, look at the recent financial crisis from 2009. 2008-9, the market drops by 50%. But I keep on telling to my students, you know, whenever you save for the long run, whenever you invest for the long run, don't get freaked out. Don't. Because oftentimes when the market drops, we feel, hey, this is the end of the world. Now it is different. Well, you know, humankind has always recovered from crisis, and the financial market is forward-looking. So whenever you invest for the long run, I always advise students to increase their investments in risky assets, be it stocks or corporate bonds. And furthermore, especially for the young crowd, if you are 20, 30, even 40, even above, you're still young, you're more than 20 years till retirement. Of course, in the media, they will tell you, hey, you know, our pension funds are losing money, blah, blah, blah. So much noise. Actually, perhaps a good advice is just to disregard those guys in TV that really intimidate everyone. You know, the war is over, we are going to lose our savings, blah, 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 blah. Noise, noise, noise. Because in the end of the day, the markets are bouncing back. And people, you know, it turns out that whenever you look at the Israeli stock market, from 1996 to 2006, 10 years, I left Israel in 1996 to do a PhD in the US. Over those 10 years, the market has gone up by 300%. Retail investors, namely people like you, like me, not institutional investors, over that period of 10 years, the market goes up by 300%. They lost 60% of their money. And you ask, how come? And then you get a good answer. You know, they sell when the market drops massively, and then when the market recovers, they never buy back. They do. but they do buy back when the market stabilizes. But when the market stabilizes, it is on a much higher point. So there is definitely a big tendency here to sell low, to buy high. As a result, retail investors keep on losing money trading stocks. If people are telling you, private traders, we did, trade that stock, we did trade the other stock, we made lots of money, don't believe them, because the vast majority of individual traders do lose money. Why? Because poor market timing and very bad security selection. Now, looking at the markets, I have to admit, I'm overwhelmed. The US market, the NASDAQ has wiped out all the losses, and today the futures are positive. And when I read opinions of market participants, I see that there is a big divergence of opinion. Like JP Morgan is telling you things are okay, markets are reasonably priced, they are forward-looking, and there is a big stimulus coming up from the Fed. In fact, here, there is a big list of why it is not crazy that stocks are rising, even though 26 million people in the US are out of work. By the way, today, there is going to be a job report in the US. Probably the figure is going to be updated upward. It's not 26, it is about 30 million. Don't get it wrong. The markets have gone up in the US for one major reason. It's really the massive Fed intervention. Right now the US government is issuing bonds to finance the crisis. They're issuing more than 3 trillion worth of bonds. And all the proceeds from that bond is going to be invested in the economy. So by doing that, by this massive intervention, the Fed is telling you, hey, no worries, I'm going to provide liquidity. No worries, I'm going to buy corporate bonds. And I will tell you why this is the most important thing. And I'm also going to buy municipal bonds. In Hebrew, איגרות חוב של רשויות מקומיות. And furthermore, there is a big fiscal stimulus, namely the government is paying taxpayers that are really paying households money to spend on consumption. And right now, massive investments are actually planned in infrastructure in the US. So right now, those who tell you the market is reasonably priced, they tell you the market is reasonably priced for a couple of reasons. First, the technology sector, is going to benefit from this crisis. And the technology sector today accounts for a very large fraction of the S&P. Actually, Microsoft posted financial statements only during the past week, not this week, the week that beforehand. And Microsoft has come up with phenomenal performance. And when you look at Google, when you look at Facebook and other tech companies, it seems like the damage is quite limited. So those telling you why financial markets are reasonably priced, because technology is not as severely hurt by the crisis. And right now we are in the era of technology. That's exactly one good reason not to follow Warren Buffett. Because Warren Buffett is a value investor. Warren Buffett before the crisis invested in US banks, in US airlines, in value stocks. And the value stocks really dropped almost dead during the crisis. So one reason why the markets are reasonably priced is that, technology is there are some bullet points. So a non-trivial fraction of the S&P consists of Microsoft, Apple, Amazon, Google, Netflix, and those stocks are believed to be safe. If you ask me, I think they're overpriced, but again, my judgment is my own judgment. I think that Apple is overpriced. I think that Amazon is overpriced. I think that Google is overpriced. But the market believes differently. Plus, there are many very solid semiconductor stocks like Intel. INTC is the ticker symbol of Intel, and Micron Technology. So those people telling you that the market is reasonably priced, they tell you, hey, technology is here and technology is almost unhurt. Plus, yes, many people lost their job, but those people, sorry to say that, they belong to the bottom of the food chain. They earn below average income. And if 20% lost their job, 80% are still working. And those 80%, every month, the pension funds get liquidity and they buy stocks, okay? So here, actually, I would like you to go to the presentation. I give you a couple of points why it is not crazy that so many people are unemployed. Nevertheless, the markets are advancing. And there is something which is the most important here. Don't fight the Fed. This year there is election in the US and the Fed is intervening massively. The Fed is basically telling you, hey, I'm going to buy all the market if needed. And some people are telling you, hey, it's not the Fed because the Fed is buying bonds. It doesn't buy stocks. So it is not really the Fed. No, that's a big mistake. Yes, the Fed is buying bonds. But by buying bonds, the Fed is really reducing the risk in the economy. I will give you a couple of examples. Take Ford Motors. Ford is, producing cars. And Ford actually got hit very severely by this crisis. And no one wanted to finance Ford. So Ford couldn't really take loans from the commercial banks. Now, when the Fed is coming and saying, yeah, I'm going to buy everything if needed, so Ford can issue bonds, even if the Fed doesn't buy them in the end. But the Fed is telling you, I'm going to buy everything. So then the Fed is allowing Ford to issue bonds. And then the risk in the economy is diminishing, which gives boosts to equities. Actually, another interesting story is Carnival Cruise. Those of you in the Israel economy, Arison. Arison owns Carnival Cruise. And the company wanted to have some financing at the beginning of the crisis. They couldn't find, so they went to hedge funds. And hedge funds actually, there was a consortium of hedge funds telling Carnival Cruise, we are going to borrow you money, huge interest. And if you don't pay the loan, we are going to take over the company. So Carnival Cruise was about to be shifted from the stockholders to those hedge funds. But then the Fed came up and said, we are going to buy everything. So Carnival Cruise could actually raise financing in the open market. So the Fed actually came up with a massive intervention. And currently it seems like the Fed is really saving the market. If you ask me, that's my opinion. After the elections, there is probably going to be, the trade war with China is going to escalate. Now they try to tune down the flames, but the flames are going to bounce back. So, honestly speaking, there is a huge prospect of a huge crisis in the US coming up before or after the election. But nevertheless, we as long-term investors shouldn't incorporate that into our investing decision, because in the end of the day, we allocate every month some amount to equities. And maybe a crisis will come, maybe a crisis won't come, okay? We wouldn't like to avoid the upside of equities, because right now, all the other instruments are giving very low returns, be it money markets, be it commodities, and other investment channels, real estate, and so on and so forth. So actually, this slide is to tell you, yes, the S&P often drops massively, but it always bounces back, okay? And from a long-run perspective, nothing really beats investment in equities. Long-run perspective. Here you see what happened in 2008, 2009. The S&P is dropping more than 50%. Today, the prices are much higher than before the crisis. Okay?
Doron, I'll just, sorry, I'm interrupting 1 second, just so you have the time in front of you, because we have something like 10 more minutes and then Q&As.
Okay, so we have 10 more minutes, so...
give or take, we can be a little bit flexible, but just a little bit.
Okay, that's good to know. So I have 10 more minutes. Let me actually use those 10 more minutes. I will show you a little bit more about equities, and then I'm going to switch. So the S&P during the dot-com bubble of 2001, to remind you, the Nasdaq then was more than 5,000 points, and then it dropped below 2,000 points. The dot-com mania period So the S&P is dropping, but is bouncing back really quickly. So here we have the massive intervention of the Federal Reserve. You know, I have some notes here for you, so please feel free to read it. I can tell you this intervention is something unheard of. And this intervention is calling for some crisis, debt crisis, because in the end of the day, the US government is borrowing money, and the money should be returned to the lenders. So there is this question, how to pay back the debt. So there is definitely a big risk here of the US government unable to repay the debt. And this is something that we cannot really ignore. The bond market, a little bit about the bond market. As you can see, US treasuries that are perceived to be safe assets, when the stock market is dropping, the US bonds are rising and the German bonds, called bonds, are rising. Why? There is this notion of flying to quality. During financial crisis, corporate bonds and equities are perceived to be very risky assets. And the idea here is that we would like to fight to quality, so people are buying US treasuries. And then when the risk drops, the price of US treasury drops. And once we look at corporate bonds, so there are high quality bonds like investment grade, and there are low quality bonds. As you can see, corporate bonds are falling because corporate bonds are not government bonds. Corporate bonds are risky. But once again, there is overreaction. There is a crisis and there are top-notch bonds. And the price drops. So if indeed you are quick investors, you follow the market, you understand that the market is overselling high quality bonds. And that's exactly the point when sophisticated investors should buy those bonds, because people are redeeming money from the funds are selling bonds without discriminating between very good bonds and other bonds. So high quality bonds in Israel and the US got hit, and that's exactly the point of good investors, smart investors, to step in and to buy bonds. So high quality bonds have bounced back very nicely. Low corporate bonds are still much below the pre-crisis level, because still there is a huge risk in these high yield bonds. HYG is the ticker symbol of an ETF. ETF is like a mutual fund that invests in high risky bonds, high yield bonds. So once again, there are good opportunities in equities and there are good opportunities in high quality bonds as well as low quality bonds, because the market is often overreacting. And smart investors, they step in and they pick up those bonds that are expected to recover. Also in Israel, the bond market dropped massively so. And then it bounced back. In fact, in Israel, we owe a big thank you to the US government. You know, you can tell in Israel things look good and so on and so forth. Yes, indeed. But the financial market has bounced back. Financial market, both equity and bond, in large, due to the massive intervention of the US government and the Fed in the financial markets. Well, one thing to be said is about two very prominent commodities, oil and gold. First, gold is perceived to be a good hedge against crises. This chart tells you, well, not really, because during the massive drop in the equity market, in the bond market, gold dropped as well. So if people perceive the gold to be a good hedging in financial crisis, this chart tells you, no, that's not the case. You know, perhaps the best story of this crisis is come up from the energy. Obviously, you know, whenever the world is heading towards recession, the oil price drops. Actually, right now, we have two forces that impact the oil price. First, oversupply of oil. There is too much oil produced in many, many countries. Second, diminishing demands following the economic slowdown. So oil companies have dropped. In Israel, you know, Kvutzat Delek, right now, Tshuva is trying to avoid bankruptcy. So he's selling other assets like real estate to finance, you know, the energy crisis. And actually there was some historical event. And I would like to briefly explain this event because this event is really important. You know, if you follow the news in April 2020, you know, you read some headlines that oil prices got negative. Indeed, that was the case. So what really happened there? Well, so oftentimes oil is traded through commodities, through futures. You know, if you study finance for your master's degree, you will get better understanding of what futures are. And there was a future, you know, it was expired. There was a contract that got expired around the date, April 20. And back then, you know, people who were long in the contract, they were supposed to get oil, the physical commodity, but they didn't have any place to store the oil. So because there was a shortage of facilities to store oil, the oil price got negative $25 per barrel. Ever since the oil have been flying high, today it crossed the $25 per barrel, and possibly in the future it will go very high because following this huge event, there was a huge cut of production of oil around the world. So I wouldn't be surprised if we will see the oil price getting inflated over the coming days. Cryptocurrencies, either Bitcoin or Ethereum, they really dropped dead during the crisis. So if you think, hey, equities don't do well, bonds don't do well, gold, maybe cryptocurrencies, well, the answer is they don't, because they really crashed with the market crash. Well, you know, just something quick, you know, I have only 30 minutes, so I would like to be comprehensive here, so I will make some quick comment about factor investing, and then I will conclude. How many minutes do I still have? Did you have 2 minutes?
A few minutes, Doron, that's okay.
Okay, yeah, so I'm almost there. Factor investing. So, you know, oftentimes, you know, we financial professors and practitioners, we tell you, hey, there are some ways to beat the market, like go with momentum, go with quality. And there are some ETFs, like mutual funds, that trade those factors. So this is about stock picking, and I can tell you that during crises, those sophisticated strategies, like go on momentum or go with quality stocks, they don't work. They're doomed to fail like the other strategies. So factor investing is not really doing well during recession. So if I were to summarize this presentation, and I think you should definitely extract some lessons here, you're all young guys and you are going to serve for the long run. So oftentimes you say this crisis is different, but nevertheless, history repeats itself. There is herding, tofata eder. People are selling stocks when the stocks are low, and they buy them back when the stock prices go up, and the same applies to bonds. Now, in terms of recovery, so right now we don't really know what the shape of the recovery will be. It might be V, it might be U, it might be W, it might be L. What does it mean? V means fast recovery. V, you know, it quickly drops, it quickly rises. We don't know if we are going to see V. U, there is going to be a recovery, but a slow one. W is something that I'm really scared of. W means that there was a drop in recovery, and there is going to be another big drop, and then another recovery. So right now, looking forward, are we going to see V, W, or U? We don't know. L is also a very unappealing scenario. It means there is a drop, and there is going to be a very, very, very slow recovery. But nevertheless, whatever we see V, U, W, or L, from the perspective of long-term investors, I did say it before the crisis, I do say it everywhere in front of my students and others, that even when there is financial crisis, business as usual in the following sense, rebalancing is very costly. People who said, let me just sell the stocks or sell the bonds and buy cash, they lost. So a long-term investor should not rebalance during crisis and have major fractions invested in risky securities, including corporate bonds and stocks. Of course, housing has always been a wonderful investment because the volatility is very low. We don't really know what will happen to housing prices. I can tell you after the 2008 financial crisis in Israel, they skyrocketed because people actually diverted money from the financial markets to the housing markets. We have to avoid commodities. Commodities like oil, like gold. On the long run, they don't give you any return. And we also should avoid cryptocurrencies. And something additional that we need to avoid, some sophisticated students, they try to trade levered investments. Like you see the market is dropping, let me buy a levered ETF. That if the market rises, I'm going to earn more. Typically, those investments don't work. So the idea here is be nerd for the long run. Invest in risky assets. Don't freak out when crisis comes. Business as usual. Rebalancing is extremely costly. I'm basically done.
Thank you, Doron. And I think it has been extremely interesting to get your view of the market. And with your permission, there are a few students already with questions. Let's start with Hadar Tamarkin. You had a question. Would you like to unmute yourself and ask it?
Hello, can you hear me?
Yes.
So my question is about the asset pricing models right now, because we know that the Fed is just buying everything. So how can we rely today? And are these models still relevant today when the Fed is just buying any asset available?
So when you say asset pricing, I'm trying to see what you're saying, because the CAPM is an asset pricing model, right? It tells you how stocks are different in a cross section. So do you mean, does the CAPM hold during period of crisis, or did you have anything else in mind?
I mean, the CAPM is one model. Can we look at the dividends or the multipliers? Everything that we look on today.
Hold on. So basically, there are asset pricing models and there are valuation models. I guess what you're asking is about valuation models, right?
Yes.
Okay. So that's a good question. And actually, I was requested to give you one question for this lecture, and that's precisely going to be my question. Valuation is about expectations, discounting the expected cash flows. And valuation models are about expectations. You can say my expectations are very high because of the Fed intervention. So if expectations are high, that could justify why asset prices are very high. The question is, are those expectations rational? Could they rely really on rational setup, or perhaps they are biased? So if you ask me, even before the crisis, the way I understand financial markets after a couple of, more than 20 years of research, I think that, even before the crisis, expectations are not really rational. Namely, expectations are biased. And there are many different sorts of biases. If you ask me, my judgment, and again, I might be wrong, I think that expectations are really too good relative to what they should be. That's my own perspective, especially in the US market.
Okay, thank you.
Yeah.
Team Amphi, would you like to ask a question?
Yeah, sorry about the name. I couldn't change it.
Better than last week.
Yeah. Basically, I was wondering, and maybe I'm not understanding something properly, but if the Fed is like lending at a lower rate than they're going to be getting the returns from buying the various assets that they're going into, wouldn't that be a reasonable idea?
Well, the Fed is not really lending. So the idea is as follows. The government is borrowing, right? And the government is borrowing from the open market. And the Fed is telling you, if no one is going to buy, I'm going to buy. So in a sense, when the Fed is buying US bond, it is like he is lending, as you point out. But, what he really does is actually printing money. And then there is a question, should we print money in the economy? Some economists say yes, some economists say no, because once you print money, it's going to boost inflation and so on and so forth. So right now, the basic understanding is that, at this point, the desire is that the government is going to borrow money from the public and the government is going to repay the money. If the government is unable to repay the money, then there is going to be the printing of money effective. Right now it is an option, but it is going to be effective. Namely, the way the US government is going to finance its activities is by printing money, or the Fed buying what the government is issuing, the bonds the government is issuing.
Thank you, Doron. Andreas, you had a question about cryptos?
Yes, hello. It was a very good session. Regarding the cryptocurrency, especially about the Bitcoin, right now the Bitcoin is almost get back to before the crisis, almost 10K. And the halving is in the other side of the corner in another 3 or 4 days. What can you say about the Bitcoin specifically, the halving and the long-term investing in Bitcoin for 1 year and a half, like the 3 other times that we already saw? It was amazing.
Let me answer it very short. 2 years ago, I was in Hong Kong, and in Hong Kong, in China, they like to gamble. Many of the gambling around the world is really done in China, South China, and so on and so forth. And back then, I participated in many meetups, and the Bitcoin was around 20,000. People told me, hey, Bitcoin is a wonderful investment. And my answer to them was as follows. Bitcoin is not an investment, it's a gambling. Bitcoin doesn't have fundamental values. Apple does. Apple sells, devices. Bitcoin doesn't. And what I told them back then is the Bitcoin probably will slowly drop towards zero. Well, people say that the marginal, the price of the Bitcoin should be the marginal cost of extracting Bitcoin, which is around 3,000 or 4,000 or so. So if you ask me again, it's like you are flipping a coin. I don't really know. Maybe you're going to be a good flipper. I'm not. It is a 50-50. But the Bitcoin is not an investment. So when you think about the long run, you would like to invest. If you would like to gamble, it's fine. So do Bitcoin. But Bitcoin doesn't have fundamental values. And like it bounced back, it can drop back to where it belongs, okay? So again, we teach investments here, in my classes at least. We don't teach how to gamble. Bitcoin is not an investment.
Okay, thank you.
Marianne Rosenthal had a question about industrial real estate.
Yeah, so hi everyone. Thank you for the great lecture. I was just curious to hear what your take is on industrial and commercial real estate as an investment short term, considering so many small, medium businesses are kind of crashing during coronavirus.
So about the real estate sector. Well, the real estate is a very important sector for the economy, and there are different niches in real estate. So there is the hoteling, hotels are real estate. And there are the commercial real estate properties. In Israel, we have Swan, we have Herzliya, big. There is real estate for offices, and there is real estate for housing. So right now, what we see is that, of course, the hotel industry is getting hit very hard. And, who knows? Who knows whenever we're going to be again in hotels? There is a big uncertainty here. Commercial real estates, like those closed malls, like Herzliya or Swan, it will take probably some time until the crowd gets back to those malls. Okay? Offices actually are a little bit less sensitive because many of the offices, like in Israel, are rented to high-tech companies. And there are actually contracts for about 5 years, and those are real estate located in prime locations are less sensitive to the crisis. Of course, there is going to be some sensitivity. So it really depends in which niche of real estate. Hotel, big damage. Commercial real estate, there is some damage. Offices, the damage is smaller. About housing, real estate, right now there is definitely a major crisis in Israel and elsewhere. And I think that here actually the government is really failing to understand why, because many of the transactions got frozen. So people don't really buy right now housing. And furthermore, the construction itself got delayed because not enough labor and not enough raw material. So there was actually a big damage along the supply chain. So the housing industry got actually hitting both from the demand and the supply side. And I think this is a very sensitive sector to the crisis. Of course, strong real estate companies, strong housing companies can take advantage of this crisis. Because, you know, right now, the small companies that need liquidity, they cannot raise funds from the commercial banks in Israel. The banking system in Israel, they shut down, you know, any financing, you know, to real estate companies that are not highly liquid. And as a result, those companies go to Ashar Chutz Bankai, which is off-banking system, and then they pay much higher interest rate. So I think when it comes to real estate in Israel, real estate prices, housing prices will probably head north in the future because the population grows. And I believe there is going to be a massive immigration to Israel from the US as well as Europe. I guess, you know, many people living there feel unsafe and they feel much safer in Israel because in Israel, I think we have been able to manage this crisis better in many, many ways. So demand for housing will always be here. But over the short run, I think the big real estate companies are going to benefit, whereas the small real estate companies, the less liquid, will certainly disappear.
All right. Thank you, Doron, for a great lecture. I certainly learned a lot about different investment routes that are possible, and I'm glad to hear that I was wise.
Now I would like to ask a question, because I need to ask a question to students, right? So it's going to be like an assignment, right?
All right.
So here is my
Take
question.
it offline also, Doron, if you want.
Hmm?
You can also take it offline.
You can send us and we'll send it to all the students.
Yeah, so let me just tell the question, okay?
All right.
Yeah. So it's actually very important just to go back to the slide. So whenever I show you the VIX index, so the VIX is telling you what is the market expected volatility. Okay. It's about expectation from volatility. And I would like you to write like a one-page document about market expectation about returns, not about volatility. At this point in time, what does the market expect will happen over the next couple of months? And you can actually use the financial press. There are many articles. You can look at the level of the index, but I would like you to try to extract market expectations about future recovery. In particular, we did actually mention different types of recovery, right? We did say recovery can be the V shape, it can be the U shape, it can be W, it can be L. I don't know. What does the market think on average? The market is an aggregate of different views. I would like you to write down some paper, like one page, about market expectations for recovery. Fast, slow, another drop and then recovery, or L shape. L shape is a very, very slow recovery. So that's actually what I would like you to do as an assignment for this lecture.
Okay, we will articulate that more precisely in writing. Thank you, Doron, and
Sure.
thank you, everyone. We will meet in 5 minutes for our next lecture. And again, Doron, thank you very much for a great.
My pleasure. Good luck to anyone. Bye-bye.
Thank you so much. We'll meet at 1:30. Hi everyone. Hi Dana. We'll wait one more minute just because we went for a break late, so we'll wait one more minute. Okay.
Hi, Dana.
Hi.
I will introduce you in a moment and then we can start, all right?
Okay, great.
I promise to do it short and brief.
Okay.
And like we go for like 30 or 30 something minutes, and I want to let them have some time to ask questions. How do you wish that?
I was here also in the previous lecture, so I could see the model.
I think this format goes well, like that when they ask at the end.
Right.
Hello, Professor Peckelman. We see that our dean joined us.
Hi, yes, I did. I do. Good. I attended the last lecture as well.
Great.
Okay, and I'll do the homework.
You will be graded.
Yeah. No, pass fail is sufficient for me.